And I am a Dr. Kolli. I'm a psychiatrist here in Pittsburgh for past 31 years, and I'm the current president of AAPI. And I welcome all of you for our financial wellness seminars, which is one of the part of our yearly event, the all year long events, which we have been doing. This year, we focused on physician wellness, including physical, mental, and also to some extent financial wellness, because that's part of our taking care of ourselves. So we are notoriously famous for not taking care of ourselves and putting other people's ahead of ourselves, prioritizing other people's wellness and health and wealth prior to us, prior to our own taking care of ourselves. So without much further ado, let me welcome you all to this financial seminar. Uh, and obviously, this is a sponsored webinar. So please consult with your own personal financial consultant to make any final and important decisions regarding your finances. And AAPI is a nonprofit organization, and it's an educational webinar only. And please, again, talk to your advisors and attorneys for any more personal advice. Especially, there's no dull movement in financial sector. It seems like something or other happens all the time. Either it's like going up or going down or sideways. So there's always some action in financial sector. Especially nowadays, there's a banking crisis happening both here in the USA as well as internationally. We have the Silicon Valley Bank, Republic Bank, and all those facing some hurdles. And the government has stepped in and taken some actions. So our speaker will put everything in the perspective of how to understand this. And then we have some international Swiss banks issues also looming in the big picture. So however confident we all feel about our current portfolio, it's always impossible to be certain with all these headlines happening. So we're all concerned about all these international and national banking crises, and we want to seek some advice whether they should move the banks out of large banks or small banks, or do what to do with them. And also on top of that, we have a filing deadline coming up on April. I guess it will be 18th. 15th is being Sunday or Saturday. It'll be 18th or something like that. So for 2022 taxes for to be filed in 2023 now. So to discuss all these nuances, very important topics, we have our good friend, Mr. Syed Nishat, who is a fiduciary financial advisor and a partner at the Wall Street Alliance group. Syed has written many articles and has done many interviews on media about asset protection, including common financial mistakes the physicians commit more commonly, and has been published in MedPage Today and Medscape. He's also regularly quoted and interviewed in other outlets, including Forbes, Kevin MD, US News, Investment News, and Yahoo Finance, etc. So would like to make it interactive, not very boring. So Syed is very good at that. He keeps it very concise, but very focused presentation, and then gives some time for interactive format. So he's very good at that. So you will enjoy his presentation if you haven't been in his presentations before. And I'll ask a few questions to begin with, and then we can get the ball rolling. And then you can ask your questions in the Q&A tab here primarily. And then we'll pose all those questions either in one by one or in a combined format. So let me, Syed, thank you for coming, and thank you for again for supporting AAPI with your webinars and financial information webinars that you provide to us. And okay, let's start with the important question. Let's say, let me ask you, how do you explain the current banking crisis and how it affects the entire physician financial planning, right in the short term as well as medium term and long term? Go ahead.
Yeah, thank you. Thank you, Dr. Kolli, for the kind introduction, and thank you. What you do for AAPI is an effortless job, what you're doing, and you're doing an amazing job. Now, in terms of the banking crisis, I think this news, we heard it when I was traveling with you in AAPI, Alabama. And at the time that we saw that, Silicon Valley Bank suddenly shut down. So it wasn't the news on the weekend. but no one really paid attention. Maybe it was just a small bank, but it's not a small bank. It was the 16th largest bank that actually, running out of cash. So people didn't pay attention at the time, but by the time I flew to New York, in New York, a Signature Bank shut down, and then First Republican suddenly start going under either. So that becomes like a snowball effect that, okay, where it's going to hit, and then suddenly I'm getting a lot of phone calls from clients. By the way, what happened the money with you? What happens, like our custodian is National Financial, which is Fidelity. If Fidelity shut down, what happens? My bank, a lot of my clients, Dr. Kohli, they're like out of New York as well, like Florida or even like Alabama. They were saying, I have like small banks. Should I just take money out and move it to the bigger bank? But this panic mode is quite normal, because even myself, like when I was listening to this news, I was thinking, should I just move my money from different banks for the FDIC limit? But I think for the investor should take a pause and try to understand what happened first, with the Silicon Valley Bank. When we deposit the money, like I deposit my own money in the saving account or checking account into a bank, what the bank does is take this money like an account receivable, and they usually buy something called US Treasuries, long term, 30 years US Treasury bonds, they usually buy it. And previously, the bond rate, the CD rate or the saving rate was almost zero, but the 30 years treasuries, the rate was decent for the bank, about 4 or 5% they're making. So they make money from your deposit, and then your money is kind of staying in the bank. Whenever you need it, you don't like chunk take out the whole the money. You take out slowly the money. That's the whole goal is. Now, what happened? This whole orchestra that Fed is raising the interest rate, right? So for the last 1 year, the issue is treasury. So what happened? The treasury rate, short term, the 30 years treasury rate is 5. Just to give you an idea, that 3 months treasury bills. Treasury bills means that you buy treasury, you hold it for 3 months. After that, there is no lockup. Your principal is safe, and interest rate right now is about 4%. And the beauty of treasury is that there's no state tax or local tax. Like I'm in New York, I pay no state tax, no local tax. If you put the money into the bank in CD, you have to worry about paying state and local tax. So what people are doing, they're moving the account from the checking account to the brokerage account, or they're taking the money out and putting directly with US Treasury. This outflow of money is more than the inflow of money, depositing the money. And then what happens if the rate keep going higher, where Fed is keep raising the rate because the inflation is through the roof? If Fed keep raising the rate, what happened? The 30 years treasuries that the banks bought at, their price are dropping. Let's say you withdraw the money, they have to sell something to give you the money. So they are selling those into a loss. So that's why you see Silicon Valley, unfortunately, ran out of cash, is because the loss are more and people took more money out from the bank. The cash was less because of this issue. Now you might be saying, okay, what happened to my money if I put the bank? My money is gone. No, the money is not gone. Understand one thing, Fed stepped in. They said that doesn't matter if it's 250 or half a million, all depositors' money, regardless of the circumstances, are all liquid. Nothing to worry about. But still, Dr. Kohli, you must have heard the news, like all the celebrities coming in newspaper and saying, "I lost my money," right? With the Silicon Valley. What happened? They lose money because they bought something called bonds. Bonds of the Silicon Valley Bank. Bonds means you buy the bond of the company for a certain period of time, let's say 1 year, 2 years, and they give you a rate, let's say 4%, 5% rate. Unfortunately, if the bank goes under, if the stock of the bond goes under, you lose the money. So that's why how people lost the money. So depositors are fine. It's just like people who has invested the money with the bank, they unfortunately has gone down under. Also, just to elaborate a little bit, your money have FDIC insurance, SIPC insurance as well. As long as the money is about $250,000, that's the FDIC insurance. But in my career for the last 18 years, I have yet to see that a bank completely shut down and the investors have lost the deposit also. If that happens, trust me, we have bigger things to worry about. So all I'm saying to the clients right now, I understand the panic situation, but as long as you have the FDIC limit up to the extent about 250, you have multiple accounts, I think you're good to go.
All right. So it's a good point. So if you have, let's say you have 2 or 3 accounts in the same bank, each one more than are around 250. So each account is separately protected by the FDIC insured.
Yeah, a lot of people have the misconception is 250 per bank. It's actually account ownership.
Right.
That's what you have to worry about. So let's say, for example, if it's like a joint account, the amount is 500,000. If it's a corporate account, that's separate. If it's a revocable trust account, I'm just saying revocable trust. Let's say husband, wife, me, and I have my wife, and I have two kids. They're the beneficiary of the revocable trust. So the amount is not 250. The amount is 250 times 4, which is actually 1 million. So
Okay.
revocable trust have a $1 million, FDIC protection there. So that's why it's important that you speak to. Don't get panic unnecessarily. Speak to the banker. How much is the protection amount? As long as you have this different ownership, you should be okay.
All right, great. So that's kind of reassuring.
Yeah.
And but coming to, I think did they increase the limit, FDIC limit of protection from 250 to unlimited for those two banks in West Coast?
Yeah,
Right.
so regardless, so they are saying that to make it the panic mode of the investors to calm them down, they're saying regardless of 250, half a million, all money are fine.
Okay.
Your money is liquid. That's fine. But obviously, as an investor, you should make sure don't have more than that amount I spoke about.
Right. And another good point you made is people saving the money in the bank versus people investing in the bond. They have two different categories. That
Categories
protection is different. Right.
between
Very good.
different. Yeah, right.
So beside the banks, so what about the brokerage account? How does that work as far as the FDIC and other protections are concerned for those brokerage accounts?
Yes, it's a good point. So people think that the same thing FDIC is applicable for the brokerage account. No, they are something called Securities Investment Protection, SIPC insurance. So that's $500,000 for cash portion only. But remember, when you invest those money, you are investing into particular securities. All right. So as long as those securities are there, different investments are there, you're okay with it. Now, in order for to lose money there, the securities have to file for bankruptcy, obviously. So as long as you're diversified investments, I think you're fine. But the cash portion for SIPC is only 500,000.
Okay, very good. I think one of the questions that was brought here by Dr. Shah, you're saying if it's a joint account, the protection is up to 500K by FDIC, correct?
Correct. Correct.
Okay, that's answered. Okay. And next question is, a lot of retired physicians are sitting on a lot of cash or on the money market funds as they're retired. What is the best strategy for them with all this cash? Even though cash is king sometimes, but you got to do something with that cash. What do we do?
Yeah, we completely understand. So we had a client in Texas, and the client was, sitting a lot of cash, about, more than few million. But we can put the money into the bank, so 250, let's say the client has, I'm just giving example, hypothetical 2.5 million. If you just want to like have a joint account, you actually almost have to open close to 4 bank account to protect. There's too many accounts you have to open. What are the other solutions for that? If someone have 10, 20 million, one solution could be from that particular bank, if they're allowed to open something called a brokerage account, move the money into a brokerage account. All right. For example, I'm giving an example. Let's say TD Ameritrade or Schwab or Merrill Lynch, you open it. Let's say you have a $2.5 million. One example could be you buy around 10 CDs, because every bank CD up to 250,000 different banks are FDIC insured. So what we have done for this specific client, we have laddered the CD. We sat down with the client, we discussed, by the way, when do you need the money? Do you need the money in a short horizon, long horizon? The client mentioned that I don't need the money. I have this much liquidity needs. So one option could be preferred money market, have FDIC insurance in certain banks as well. So put up to 250,000 in preferred money. The rest, money you have at different banks within the brokerage account, actually buy different CD. Remember, right now, even 6 month CD is giving almost 4%. What I mean by that, after 6 months, there's no surrender charges. And you can just keep laddering it. Go for sometimes 6 months, go for 12 months. So as long as you have different type of ladder CD, if you're concerned about you have a lot of cash sitting there, don't know what to do about it, you can spread it out into different vehicles. So that's one way of doing it.
Very good. So, so you're talking about when you're talking about short-term interest rate versus long-term, is that what they call it, yield curve inversion? Or is that what you're
Yeah.
referring?
So a lot of people, a lot of times people are going to banks and they're putting their money into long-term product like 3 years, 4-year products. We are recommending to the client, this is something called inverted yield curve is coming. Inverted yield curve means that there's not much of a difference between 2 years yield versus 1 year yield, not much of a difference. So why lock your money for 2 years? Just go for short term because most likely interest rate will keep going high, 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 high. So if that's what's going to happen, 6 month maximum, go for 1 year, and then most likely interest rate will be high for this year as well, that because the inflation is keep going higher. And in this way, that you have good side in both story. If the interest rate goes high, short-term CD which is maturing, you will buy another one, but and you'll get a higher yield. But in the same way, you're diversifying with multiple banks. I think that's the best route to take in terms of like if you have a lot of cash sitting there.
So before we going to the next question, what do you think about the Fed interest rate hikes? What's your theory or forecast? Is it
Yeah,
doing? Are they doing it to curb the inflation, or is it causing more panic in sectors?
yeah. So one good thing of all of it, that the main issue that this whole liquidity issue we're seeing it is because the Fed is keep raising the rate, so the Treasury rate is higher versus the bank rate. So people pulling money. So most likely, Fed will not increase the rate that much. All right. So if they don't increase the rate that much, so what happened? Like the last time, they only raised about quarter basis point. It's supposed to be 50 basis point. If that's the situation, most likely the rate of inflation may carve down and the market most likely stabilize a little bit. But it will be volatile at least for a few months, because the problem is that, Kohli, this like First Republican or Silicon Valley Bank or Signature Bank, there are some underlying investing with some ETFs out there. So we do not know, it's still coming out. Like, okay, like PIMCO, I'm giving an example, invested into this. There's some news came out. So they're having a write-off. So until all this news comes out, flush out, the market will be kind of a little bit of a volatile for a
Okay.
bit. But it's a good time to buy big banks for sure. It's a big bank, buy it like Chase, JPM, this kind of financial or ETF, those sectors will go well. Buy big technology company, blue chip. It's a good time to buy it, like Apple, Google, because they can weather the storm well, and the small cap company avoid it because they most likely will get taken over.
Yeah, that is the next thing I was thinking of asking you. What sectors do you think will have better results in the next short term, and how do you want to play these sectors now?
Right. So people are still, unfortunately having this speculative, allocation in their portfolio. I'm not saying anything bad thing about like Cathy Wood on those kind of stock, but still people have like a lot of crazy stock, like small cap, like they bought like the Zoom we are using. They like all the portfolio into Zoom. So things like this, I mean, we need to understand it will take a long time for it to recover. Is because they went up because the money was cheap and they were able to like, use the cheap money, and the labor cost was very low. Right now, the labor cost is very high. So recently we hired, just to give you a story, one of the advisor in our company, we have to pay 20% more. I'm assuming the same situation for nurses and all practitioner as well. So that's why the big companies will be able to do well. The small company, their profit margin will shrink for sure because borrowing cost is much higher. Number two, avoid commercial real estate. Those don't get in, because what happened if you see all these malls and everything, Dr. Kohli, in your area in Pittsburgh and New York, they usually make about 7%. Um, but the borrowing cost is 8% right now if you see it. So the money is not there. So try to avoid commercial real estate. Wait. I think residential real estate will go down. People still want me waiting for home. Like I'm working from home. I would like to work from home. People like it. So residential price will most likely go higher. So in my opinion, the sectors to get in right now is financial, because they are down about 10-15% from the top. Try to go for big blue chip sector. Those will go higher. But by all means, still avoid speculative stock, small cap, and also emerging market. Try to like, trim down a little bit, get into more blue chip and value stock. These are here to stay for a longer time.
Great. So, so residential properties are doing better than the commercial properties
It
and
is
malls and all that. Uh,
absolutely
Occupancy is still low. People are still working from home, and
correct.
also it seemed like a lot of people moved out of big cities into some smaller city like Pittsburgh, like smaller cities and everything. That's great.
Exactly. Exactly. Absolutely.
So now that we covered a little bit about the banking crisis and all the what sectors to work with and all that, let's go to the next point of tax planning, because that's part of our decision making, how to protect what we earn, and besides how we invest that. So give us some tax planning tips that come before April 15th, and also if we extend our tax filing deadline, what else we can do during the interval period. So let me see if there's any audience questions right now, right here. There was a question about annuities. Do you want to comment on annuities, Syed, before
Yeah,
we
so
go?
annuities, remember the same, it's a different kind of product. You have it, so annuities, again, the cash portion, the SIPC insurance, part of that. But yes, annuities, obviously the problem with the annuity is that is very expensive as a fiduciary advisor. Unless you really need it, we don't advise. But if you already have it, uh, sit down with your advisor and see if it makes sense for you.
Right. I think Dr. Shah asked about is it good time to invest in residential real estate? You said already yes, that's good.
Yes, it
And
just wait a little bit though, because the interest rate will go high because price hasn't dropped in yet. Like I want to
right,
buy a place in, if I can, in suburb. So just
yeah,
wait. Everyone still want to buy it.
right.
Yeah.
Okay. There is a question, interesting question by Dr. Kushi Tucker, Temple University. That's where my daughter is doing her psychiatry residency at Temple. From my understanding, even if you have a laddered CD, each CD having 250K, only 250K is FDIC insured, and not each ladder. If adding to more than 250K per individual, for example, 250K for 6, 250K for 12, 250K for 18, um, is it all protected? Only 250 is protected altogether.
Yeah. So if it's
What's
different bank, all protect. Remember, it needs to be different bank. Cannot be the
right,
same bank though. As long as
right,
different bank, like say you got for Chase one bank, you went
right.
for Citibank one bank, is different. Each bank is 250.
Okay, good. So I think your advice is to kind of spread it out to the
Spread it out.
different banks if you want to invest
Correct.
in different layers of ladders of
Correct.
CDs. Okay, that's a good point. And
Correct.
let's ask a few more questions that are popping up here. Home renovation is tax deductible. I guess it's a home office, right? Go ahead and you answer it.
Right, yes. So it's a so home renovation if you have done it, but it needs to be some particular reason. Like for example, you have a health reason, you have renovated it, like you have
Okay.
installed some ladders and stuff, then yes, those are could be tax write-off, correct.
And for any home office improvements also, you probably can deduct.
Yes.
Yeah,
Yeah, so
okay.
that's something I'm going to cover it too. The home
Okay,
office deduction,
okay,
you should
good.
take it for 2022.
Another question, Dr. Dave, is it good time to buy I bonds?
Yeah. So I bonds, what happened last year was a definitely good time to buy I bonds because the yield was almost 10. The same I bonds right now, the yield is about 6% right now. But the max you can do is 10,000, unfortunately, but it
Okay,
still is okay. You
right,
can buy I bonds.
right. And each person with each different social security number can buy those, I guess, right?
Correct. Correct.
What do you think about Dr. STM Physicians, ubsinc.com? What do you think about muni bonds that are tax exempt for high tax bracket individuals, investors?
Yeah, so what happened that municipals are okay. The reason why I'm saying so we are not comfortable with the whole bond portion unless like it's a pure short term. Because the issue is that every time the interest rate goes high, the bond price drop though. You understand? Only the treasury, the price doesn't drop. CD price doesn't drop. If you just go for the municipal, unless you buy, let's say I'm just giving an example, New York County municipal bond fund, and it's a 2 years lockup. If you just buy that specific municipal bond, state, local, and federal tax-free, that's okay. But some people, what they're doing, they're buying municipal mutual fund. So underneath the mutual fund, you have municipal fund. So that those prices drop though, if the interest rate keeps shooting higher. So it depends your situation, but it's okay to buy short-term individual municipal bond fund. It's okay.
So there are some other questions that will be covered during the next presentation. We'll hold on to those. But as for the sectors are concerned, what about crypto coin investment? Dr. Sudarshan Grover, my good friend from Michigan, asked that question. Go ahead and see. How
Yeah,
you
so right. So as I said, the cryptocurrency, we as I said the same thing last webinar as well. People buy crypto because the next door neighbor is buying it, and there's no good valuations out there. Suddenly the price drop all the way. And you can see all this fraud happening with the cryptocurrency. A lot of companies are shutting down. So we are not buying it for our clients. You have to do your own due diligence before you buy it. But my question is that why? If the whole market is down, the whole Nasdaq is down 30-40%, just buy those. Why even get into those? Because these are more good valuation than those stuff.
speculate? Yeah.
Yeah,
Okay, let's go into the tax planning tips here. So what are the tax planning tips for 2022 before the April 18th deadline for that
yeah.
you would suggest? And those who have a filed extension, what do you recommend doing that in between during that time?
Right. So keep in mind that because of the flood situation in Georgia and even certain parts of Alabama, the deadline has extended. So just double check which your CPA was the deadline, but the usual deadline is about 18th. So some deduction not to miss, because obviously a lot of planning should have been done last year towards the middle or the beginning. We're talking at the end of 2022. So there are last few minutes things you can do. Number one, the meal deduction for 2022, like if you're self-employed or if you're spending money for your food, usually it's 50% of the money you spend for food. But last year is the last year, only year is the meal deduction is 100%. Okay, so speak to your CPA, don't miss it. Before April 18, you can open up an IRA account, the traditional IRA, as long as you don't have a 401k and everything, you can contribute the money into an IRA account, $7,000 ballpark. Over the age of 50, all money are pre-tax. HSA. So just in case if you have a high deductible health insurance, you can contribute about close to $8,700 pre-tax money before April 18. All money are pre-tax. A lot of physicians miss out something called backdoor Roth IRA. I'm hovering my mouse here. So a lot of physicians thinks that I don't qualify for Roth IRA. It's true because your income is high, but you can contribute post-tax money into an IRA account and convert the money into a Roth IRA. As long as you do it immediately, there's no income restriction there, and most likely there will not be any profit because you're flipping it immediately. So husband, wife together over the age of 50, $7,000, $14,000, you can contribute into backdoor Roth IRA. The beauty is Roth IRA grows tax-free, withdraws also tax-free after the age of 59 and a half. R&D credit, a lot of physicians miss out, especially those who are dentists. Dentists, they miss out a lot, or cardiologists, if you have a lot of machineries, R&D tax credits is available for you. Speak to your CPA if you qualify for that. Home office deduction, because of what happened, a lot of physicians still working from home. If you have actually, so there are two ways. It's a square footage or dollar amount. Either or you can take for the home office. So depending on how much you've spent it. And number two, are you going to take a depreciation also on top of it? But usually we see the home office deduction is around $3,000 with our CPA. So it's not going to be significant regardless, because it will create a high audit that if you have a huge amount for home deduction, right? To try to just understand. So home office deductions is there. Just in case, a lot of physician self-employed bought a car. Just in case if your car more than 6,000 pound and if you're using for business, there's something called bonus depreciation is there. So in a bonus depreciation, basically you can write off the full purchase price of the car. And this money is a completely write-off for the business. All are there. So again, speak to your CPA that if you bought a vehicle and the vehicle can be a full write-off for the corporation. Educational plan contribution, if you have contributed to the 5 to 9, so that money is completely state tax deduction up to the amount the state allowed. Like New York, for example, is $10,000 ballpark, and it's a state tax deduction there. And just in case if you have filed for extension, I'm saying it that you have time to open up a defined benefit plan for the year 2022. All right. Secure Act has passed. According to the Secure Act, you can basically open up a defined benefit before your tax filing deadline. So in a defined benefit plan, 52 years old can contribute almost $193,000, and this money is a completely tax deductible. So 40% tax bracket, we're looking at a $77,000 tax saving, and in 10 years, that translates into almost close to $772,000. So again, everyone's situation is different. Just to speak to your CPA that if this one defined benefit plan makes sense for you.
Yeah, What about the Inflation Reduction Act? Any thoughts on that? How the physicians can benefit
Yeah,
from by knowledge about being aware of that?
sure, definitely. I'll get into it, but let me just share my screen real quick to finish this off. A couple of things. So I was just talking about the deduction. So one last thing I just want to show you before defined benefit plan is the cost segregation for real estate. A lot of physicians have real estate. They invest like motel business or businesses like, for example, gas station. So if you have taken extension, a typical real estate have around close to 39-year depreciation, commercial, but residential is 29. But the depreciation is up to you, meaning the depreciation you can get to write off from the rental income you're collecting. So cost segregation allow you to bring the depreciation down from 29 years to 5 years if you need to. So again, if you file for extension, if you own a real estate, speak to your CPA if cost segregation makes sense for you or not. All right, and again, it's only for real estate. And I see some question people ask that, okay, what about the car deduction? If I don't have my practice, can I still deduct it? You need to have some 1099 income though, in order to write this off. If you cannot do it, it's not going to work.
Right. All right. There are a couple of hands raised. Do you want me to bring them in? To
Sure.
ask questions? Okay. Let me get those two. One second. Dr. Dave, let me ask you to talk. Go ahead, Dr. Dave. Okay, while Dr. Dave is getting ready, I'll have Dr. Kiranmai Surapaneni wants to ask a question, so I'll unmute her and go. All right. All right, so let's wait while they're getting ready. Okay, what about estate tax limits going down in 2025? How should we prepare for that, or how should we not to be overly excited about it?
Yeah, so is it okay before estate tax, I can just finish the 2023? Are you okay
Sure,
with
sure.
it?
Yes, please, go ahead.
Yeah. All right. For 2023, a few tax planning tips for everyone for the audience. Depending on the state you live in, like New York, New Jersey, they have adopted a law that if you pay like state tax, something called SALT, if you pay the state tax, state and property tax, the maximum deduction is $10,000. One time become president. If you have your own corporation, and if you pay the same state tax from the corporation, you get the full write-off. Extremely powerful though. So for example, New York, New Jersey, if you pay the same state tax from the corporation, you get the full write-off. This year, for 2023, I'm talking about if you have appreciated stock, donate it. Again, those make a lot of sense because on the appreciation, you pay no taxes, but you get the full deduction as well. Max out your 401k, 403b plan. Definitely, it really helps because these all money are pre-tax. If you have some stock into a loss, like bank stocks which are down right now, sell those and buy something similar. And those losses called tax loss harvesting, you should be able to write off from any real estate, a profit you have it, and also the last carry forward as well. Again, Roth conversion also makes a lot of sense this year. All the stocks are down still from last year. Like if you work for the hospital for 401k, for 403b plan, they're all down right now. So it's a good time to do something called a Roth conversion because you pay less taxes because the value is down. And once you convert the money into a Roth IRA, the money grows tax-free. The withdrawal is also tax-free after the age of 59 and a half. And then self-employment physician can set up a solo 401k for the year 2023 ahead of time because that is subject to your W-2 wage if you want to defer it. So again, these are some of the strategies you can do it for the year 2023. Before I get into the Secure Act 2.0, let me see if there's any question.
All right. Some question was, if we have our own practice, can we take 1099?
Yeah. So if you have your own practice, so there are two. So if you have your own practice, so basically either is a Schedule C, or either is LLC, or either is an S corp. If it's Schedule C, everything is basically all the 1099 becomes Schedule C. If it's like LLC,
it is all basically is 1099 technically. But usually what we would like to see that depending on your income, the 1099 you collect from all different entity and you put it into your corporation and take like something called a W-2 wage as a S corp. And then the rest of the money you take as a K1. But then the K1 portion, basically all the strategies I laid out here, like pay the state tax from the corporation, buy a bigger vehicle, can get right off from there.
Okay, excellent. And what about, I think you mentioned about Secure 2.0 retirement overhaul benefit.
Yeah, so Secure Act 2.0, just very quickly, I just want to explain before I go to state taxes. It passed already for last year. Just four important things. So from the year 2025, if you're over the age of 60 and 63, the contribution is not 7,500, it's 10,000. Catch-up contribution is higher, okay? Number two, the RMD age, like over the age of 70, you have to take RMD, that went up to 73. All right. Number four, a lot of physician clients have their kids grown up, they have 5 to 9 plan. What do I do with it? There are some details into it, but what Secure Act 2.0 allow you some portion of the 5 to 9, transfer into the child's Roth IRA. All right, there's some rules regulation out there like amount and how long you have to hold it. But again, you have the option right now to put them into a Roth IRA for the child if you want to. And then this is Secure Act also passed over the age of 70. Now you can contribute into a Roth IRA and IRA account as well. So again, these are the important things out there for physician to know for Secure Act 2.0.
Okay. All right. Dr. Ravil raised his arm, but I think he lowered it. Okay. How do you recover from unrealized capital losses like investment in Zoom and Novavax and all those? Any idea, any recommendation on that?
Yeah, so those are, the question is unrealized. I think that it mentioned that means he hasn't been sold yet. So make it realized. So what I mean that sell it and buy something similar, what I'm saying. And in this way, you have the loss carry forward. So in the future, if you have any profit, you can get right off from there as long as it's an individual account, joint account, retirement account does not make too much of a sense. But tax loss harvesting makes sense because future growth, you will pay no taxes because the realized losses will be carrying forward.
Right. I think another important point, don't buy the same stock within 1 month or something, right? And that'll kind of.
Right. Another thing, what you can do that you can wait for, 30 days. After 30 days, you can buy it back. That could be one option.
Right. People buy too early, then they can't take the unrealized losses. I think one of my cousin made that mistake and learned the hard way.
Correct.
All right. There seems to be a possibility of a recession. What advice would you give regarding equities? Yeah.
So the only way to fix this inflation, recession is a must. We have all us to understand the only way to fix this inflation we are seeing is recession, right? There's no other way to fix it. So inflation is there. The question is going to be a mild recession or is it going to be like a bad recession or is it going to be a stagflation? That's the question. But we at Wall Street Alliance Group, we believe that this is going to be like a mild recession. It is not going to be something crazy. And market should be able to recover fairly quickly. That's what we personally believe in. As long as you have 5 years time horizon, you should be okay. But a lot of people thinking that the recession will fade very quickly, like you buy it and tomorrow recession is finished and the market will recover. It's not going to happen. As long as you have 3 to 5 years time horizon, you should be okay.
All right. There are a couple of interesting questions. What about vehicles weighing less than 6,000 pounds? How do we deduct? Or what can we deduct?
So that's not going to be, that's deduction is still there, but that's not going to be bonus 100% deduction though. The max is about 25K. So we're talking about 6,000 pound vehicle. And I think this vehicle deduction is important, Dr. Kolli, because this year is still available and it's sunset. It's not there going to be for perpetuity. It's going away, most likely in a few years. So I'm not saying go ahead and buy the car if the business doesn't need it, but if the business needs it, go ahead and do so because you get the full write-off.
Right. Another question is about volunteer work without compensation. How can we do it? For example, AAPI is a volunteer work. I travel a lot and spend a lot of money on that. How can I deduct some of that expenses?
Yeah, so if you do a lot of volunteer work, unfortunately, the time value, there's no way to deduct it. I mean, you have to put money into it in some sort of 501c to get the deduction. Unfortunately, the time value of the money is not there, unfortunately. But one thing could be that to think about, let's say if you're charity minded, you can open up a donor fund money there, and from the donor fund you can contribute the money, and from there you can actually write check to whatever donation you want to. Second option, if you're really volunteer minded, there's something called a private foundation. You can open it. A private foundation allows you to deduct a substantial amount of money for yourself. From there, you can be the trustee of the foundation. Someone else could be the trustee, and some of the expenses can be paid off there if it's been properly structured. So it depends. I mean, I cannot give a generic comments, but if you're really charity minded, we can sit down and discuss about it.
Right. Yeah, it's, one thing some people can do is their stocks that went up, they can transfer that to those charity funds and not pay the taxes on those.
On the appreciation, correct. Or yeah, I think that's extremely powerful. Or they can give it directly to AAPI, or stuff institution like this. So I think that definitely helps a lot.
Right. So what about earned income tax credit, EITC? Dr. Moana Khanna asked that question.
I think it's employment retention credit is asking for.
Okay.
Yeah,
Okay.
EITC.
Yeah.
EITC. So
It's not in earned income tax, employee retention.
No, employee retention credit. Yeah,
Okay, yeah. That is during the COVID, they added that. Okay, go ahead and answer that.
Right. So the employment retention credit, our clients are getting a lot of solicitation from third-party company that apply for it. Understand that this is an amendment you have to do for previous year in order to fix it. All right, employment retention credit. So this third-party companies are saying it that okay, if you haven't laid off employees, still you qualify for it. So we are recommending that be very careful, make sure that you speak to your CPA, you do qualify for it. Don't just go for this third-party company, because the last thing you want to do is IRS audit. So my clients are not doing it, but the situation is up to you.
Right. Yeah, one of the scam calls seems to be the targeting this employee retention.
Correct.
Yeah, all right. And let's see what else cooking here. Is it worth considering Roth 401k?
It does. It does. Roth 401k does make sense, especially the conversion portion I'm talking about. So the existing 401k pre-tax, you can convert it into a Roth 401k if you want to convert the money. And in this way, in the conversion, basically the benefit is that the value is down and you pay taxes on the lesser amount, and that becomes like a Roth IRA, and the money grows tax-free. Roth 401k also makes sense if you want to defer it, depending on, so if your income bracket is down right now, Roth 401k makes sense, but if your income is very high, pre-tax makes more sense.
Okay. Actually, Dr. Mona Khanna asked me, I wanted to know about earned income tax credit. Do you have anything to say on that?
I haven't, don't know much about the earned income tax credit. I'm not sure what he's referring to. Yeah,
okay.
Right.
All right, we'll research on that. And
yeah.
Dr. Naresh Dhawan, my good friend from Nebraska, Omaha, Nebraska, a physician who has retired and continued to attend CME courses, how can they deduct CME expenses? That's an interesting question.
Right. I mean, those need to be self-employed. Then from the 1099 portion, if you're traveling through it for business purpose, yeah. But it's just the business needs to have a legit reason for it.
Right. So retired physician, if you have a license, as long as you're keeping your license alive, and the license expenses for filing for the license application,
Correct.
CME credits should be, whether you're retired or not, as long as you have a license, you can.
Yeah, as long as you have a license, is fine, and you're traveling for it for business purpose is fine. But ideally, is some business expense.
Okay.
Right.
Right. Well, we do telemed from home. What part is deductible? Yeah,
the home office portion, as I mentioned to you, working from home, how long you've been working from, square footage of the house, all of this could be tax write-off, correct?
Okay. Some sector-related question. Do you feel real estate prices will fall? When do you feel mortgage rates will decrease?
Yeah, so mortgage rate most likely will keep going higher, and that will eventually lead to the real estate market to drop. So we believe that the real estate market is going to drop, and then we believe that in the next few months is a good time to buy real estate when the price drops sometimes at the end of the year, because summertime again the price will most likely not drop that much. But if you wait, let the mortgage rate goes up to around 9%, I think that's the time the real estate market will drop.
Okay. A little more details on cost segregation for commercial real estate. Dr. Sanjay Singh wanted to.
Yeah, so basically, let me just repeat. So what happened that all the rental income you collect for commercial or residential, you're collecting rent from, so it goes to Schedule E of your 1040 or your individual income, and you pay taxes on it, right? But on the Schedule E, the depreciation schedule as well. So what I mean by depreciation schedule, that let's say you have rental income coming $2,000 and there's a $500 depreciation. Property become old, the government allows you to do depreciation. That's around close to 29 for residential, 39 for commercial, meaning that depreciation you can get to write off from the rental income you collect. This 39 year, you can bring it down 5 years. This is called cost segregation study. It costs around $6,000. But let's say a property value is for $1 million. We had a client in Texas, surgical center. The next 39-year depreciation the client will collect, we were able to get it in one go, like all $300,000. And in this way, up to $300,000, this client in Texas, the surgical center client pay no rental income taxes. Rental income, taxes on the rental income. So this is called cost segregation. So again, if you're in a high income bracket right now, save the money into rental income taxes. Cost segregation makes sense for real estate.
Okay. So how about life insurance? Do you have any other points you want to cover before we have 10 minutes left to 8 minutes left for conclusion? But we have a lot
right.
of questions. We'll try to cover the questions as well.
Right, exactly. So I was thinking that if it's okay, very quickly, I want to just cover a few things.
Right.
The Inflation Reduction Act was passed also very quickly. So in the Inflation Reduction Act, basically understand that IRS basically is expecting to collect around close to $203 billion from people who are making more than $400,000. So a lot of people are getting hired from the IRS. So the physician be aware of it, that whatever all these deductions you're taking, have a good CPA, because audit, I don't think is a question of when, it's a question of if, it's a question of when the audits are happening, okay? So physician in the high tax bracket, it's already passed. Make sure you have a good CPA, financial advisor, and attorney who can do the paperwork properly for you. Have a good records, okay? Two more things very quickly. Estate tax. Right now, basically, your net worth is more than 24 million. You pay no death tax, called estate tax in America. The net worth needs to be more than 24 million to pay estate taxes. That is going down. It's coming down to altogether 6 million per person. So altogether up to 12 million husband and wife is net worth. You have to pay 50% taxes, more than that. And it is becoming law after the year 2025. So if your net worth is substantial, let's say more than I would say $15 million, you can do a few things very quickly. I want to show you, you can gift 22 million right now to your children, and all money is out of your state, number one. Every year, the amount went up about $17,000 per child. You can gift it. You can buy second to die life insurance policy. If you have a life insurance policy, you can move it to a life insurance trust. The money is out of your state. And you can do some charitable foundation as well, which we're not going to cover today, but that's money will help you to actually lower your overall state. And I just want to show you, people ask that if I gift it to my children through trust, don't I like lose control? My children own it. What if they kick me out from the house? They ask the question. There's something called SLAT, Spousal Lifetime Access Trust. Speak to your CPA or attorney. Does it make sense? In a SLAT, Spousal Lifetime Access Trust, you can gift it to the children up to 22 million. But as long as one of the spouse is alive, you can take the money out and give it to the other spouse. You have control over it. So again, SLAT makes a lot of sense if you want to regain control over it, but still the money is out of your state. You speak to your CPA, financial advisor, if it makes sense. And one quick example before I conclude, had a client, 60 years old, 15 million net worth, 200,000 the client add every year, 10 years, 7% growth happen, the value is 32 million becomes, right? So if the state law doesn't change, I'm talking about the client has to worry about 7 million paying state taxes. And if it expires, I'm just saying, talking about, and the law becomes lesser, the client has to worry about paying 12 million state taxes. Again, I'm giving an example. Now, the same client from the 15 million, 9 million, what the client can do, they can donate, they can distribute it, or they can actually gift it to the children to SLAT. They still have control over it, but this 9 million is out of your state. The clients for state tax purpose become 6 million only. The same clients, $200,000 every year, saves it 10 years, 7% growth, boom, the value becomes only 15 million. There's some state taxes due if the law comes down to 6 million each, which is 1.8 million. But take a look from the previous slide and this slide, almost $10 million state taxes. So again, high net worth individual, it's a good time. The bottom line is that gift money to the children via either SLAT or some sort of irrevocable trust, it will save you tremendous amount of money.
Right. It's going to raise a lot of questions. So actually, one of the questions, okay, go ahead, finish your presentation.
Yeah, so that's it. But as I mentioned, that all of the things I spoke about is quite advanced. No one should just jump to the conclusion and do it by themselves. I highly recommend that speak to a fiduciary financial advisor or a good CPA who can help you navigate through it, because your situation might be different, right? I mean, we are just, Dr. Kolli, you and I are talking about educational topic. Make sure that you speak to a good certified financial advisor who can sit down and go through your situation, and then they can give you an advice.
Right.
Yeah.
So we have limited time. A few more questions. How about, I think you covered it. How about using life insurance to use as a tax reduction, tax saving?
For life insurance for tax deduction, I'm not sure what it means, because the premiums are not tax deductible, but the death benefit is tax free, but it helps you in estate taxes.
Okay. Now, 403B, hospital employee still working, contributing, can they postpone RMD till they stop working?
Yeah, they can. So if they're still working, it's fine. They can postpone it. So when they stop working, then they have to start taking the RMD.
Okay. One of the question is, for you, how do you work with physician? What can you do for them?
Yeah, so in terms of us, we are a fiduciary financial advisor. There's no product, nothing. Wall Street Alliance Group was founded based on the principle is that we provide a pro bono free financial advice service for the client initially. So if you need any help, you're welcome to call us. We'll be more than happy to give you, for AAPI members, first time pro bono consultation. But obviously, we deal with clients who are a little high net worth. So we have a minimum investment requirements to be our client, which is $500,000. You can be more than happy to be our client. But as I mentioned, that we are just providing like a pro bono service one time. If you want to come or consultation, you can check us out into AAPI webinar. You can go to the YouTube. You can see all pro bono videos out there.
All right. Some interesting questions. If you're going on a cruise for CME, how much you can deduct as a business tax? I mean, I don't know. You can answer.
Right. I mean, these are the questions are like, obviously it needs to be used for the medical license, but the question becomes the CME you're going for cruise. I mean, we're not sure. We just have to sit down and talk.
Right. One interesting question, opportunity zone investment, are they still good?
Yeah, so opportunity zone, it does make sense. If you invest into real estate, if the area is opportunity zone, meaning that there's a 20% property rate on that area. If you hold on the property for 10 years, on the gain you pay no taxes. So again, yes, it does make sense to invest into opportunity zone.
Last three questions we have. How high do you expect mortgage rates to go up?
Yeah, the mortgage rate, yeah, I wish I would know, but obviously, if you compare it in 1980s when Carter was the president, it went as high as almost 18-19%. I don't think that will happen. I believe that in the vicinity of 8 to 10%, the mortgage rate short term may spike up before it goes down, because it's not sustainable. 20% is not going to work, because remember, if the borrowing cost is 20%, someone has to make 20% to break even. So short term, I think these are not the solution. Market will be volatile, but the long term, I think the interest rate will subside.
Okay. Another question related to real estate is, as we approach the retirement age, is the real estate good investment strategy compared to stock fluctuations and uncertainties?
Yeah, from a real assets, I think it is, because what happened that we always recommend to our clients some portion into have some sort of fixed income. We always recommend. And real estate, I think, is a good way to go for it, is because you have a consistent income coming in from there. But the problem with that if you do that, you have to maintain it, manage it. It's not cup of tea for everyone. And people do lose money into real estate as well. The tenants are not there, those headaches are there. So you need to be business savvy minded. It's not cup of tea for everyone, but we do recommend have some rental property if you have time.
Right. Diversification and location is also important for real estate.
Correct.
Anyway, a couple of more questions. Is it good time to convert S Corp to C Corp so that we can reduce W2 income and FAFSA for college for going kids?
No, so I think people are making a mistake, because what happened that the C Corp, the tax rate is low, and so because 20% tax rate, right? But it's a mistake. So what happened that people are converting S Corp to C Corp with understanding they'll pay 20%. But by the way, when you withdraw the money, you have to pay double taxes and again. So it doesn't work for retail clients. It's only for big corporation. Only for like Microsoft, Google, it does work. It makes sense, because what happened, they have some money access they needed for hiring purpose, for research purpose. Those money going to be there perpetuity in the company. All right. And they give money to the shareholder as a distribution, as a dividend. So it's the other way around. If you have a C Corp for retail investor, convert into an S Corp, because in C Corp, you pay full Medicare tax, 4% on the whole amount. If you have a S Corporation, you convert it in the W2, you pay Social Security, but on the K1, there's no Medicare tax. So you save 4% Medicare. So other way around, if you have a C Corp retail investors, most of the time, S Corporation makes sense.
Okay. One last question. That will be the 40th question of the evening. So should high net worth individuals buy life insurance to help their children paying taxes for inheritance? And okay, that's the question.
Yes, they do. If you don't want to gift it at all, and one option could be you can buy something called a second to die life insurance policy. In a second to die life insurance policy is very cheap. It only kicks in when husband and wife both passed away. Usually it's very cheap. You can buy it. Move the life insurance into an irrevocable trust. In this way, the money is completely, out of your state, so it can pay for it if you want to. Yes.
Okay, I think you really covered a lot of issues today. In spite of being a weekday and nighttime, spring break, almost 120 people came. That's a testimonial for your popularity with our crowd and the topic that you covered. And hopefully we'll continue to engage with you and have more learning opportunities for our members, as well as some connection with your system. And I also want all of you to come to our AAPI convention, July 6th to 9th in Philadelphia. Please sign up, and we're looking forward to having you there. Again, like tax deadline, the registration early bird is April 15th. We might extend to April 17th. More discussions about financial planning there too. And I think, thank you so much. And I really appreciate all of your participation. Syed, again, thank you for your sponsorship and your educational webinars that are so engaging for all of our members.
Thank you, Dr. Kolli. The recording will be available, for the AAPI members. We'll email it to everyone.
Thank you.
All right. Thank you.
Thank you, and
all right.
see you all. Take
Bye-bye.
care.
See you.
Bye-bye. Good night.
Good night.